Let's go ahead and talk about long-term contracts where there's an overall loss. Now, when estimates suggest that a contract will be a money loser overall, we need to recognize the loss right away. This is a part of our accounting conservatism where we anticipate all losses. Now, even if we're using the completed contract method, where normally we don't recognize income until the contract is completed, if there's a loss, we still want to recognize the loss right away. Now let's go ahead and assume we've got the following information regarding a 4-year contract. The contract price is $2 million, and that's constant throughout the 4 years. In 2001 and 2002, we think the expected total cost will be $1.7 million, so we expect to make a profit of $300,000. In 2003, there's some cost overruns or some cost increases. The expected total cost goes up to $2.1 million, so now we expect to lose $100,000. In 2004, the 2003 expectations play out, and we do in fact lose $100,000. Now, under the completed contract method, again in 2001 and 2002, we wouldn't recognize any revenues or expenses at all. We would normally wait until the end of 2004 and close construction and process to expense and the billings on construction and process to revenue. Since in 2003 we expect an overall loss, we need to recognize that loss right away. So we're going to go ahead and debit loss on long-term contract and credit construction and process. At the end of the 4th year, we do in fact lose $100,000. Now we've already recognized that loss in 2003, so in 2004 we shouldn't recognize any additional income or loss. At that point, the balance in construction and process is $2 million. The $2.1 million of actual costs would be a debit balance, less the $100,000 credit from the above entry. When we close construction and process to expense and billings to revenue, we'll show no profit or loss. Remember, the whole point was we wanted to show the loss in year 3. So again, we close the billings to revenues, $2 million. We close construction and process to expense, $2 million. So on our income statement, 2 million revenues minus 2 million expenses, 0 income. Now let's go ahead and change this a little bit so that in 2004 things improve, and instead of losing $100,000, the final result is we actually make $50,000. In 2003, we again need to recognize the expected loss of $100,000, so we debit loss on long-term contract and credit construction and process for $100,000. At the end of 2004, construction and process has a balance of $1,850,000. The $1,950,000 of actual costs, less the $100,000 of credit from the previous entry for a net balance of $1.85 million, will close construction and process to expense and billings to revenue and show a $150,000 profit in year 4. Again, revenues of $2 million minus expenses of $1,850,000. Over the 2 years combined, we're going to show the correct profit of $50,000, a $100,000 loss in 2003 and a $150,000 profit in 2004. Now, let's go ahead and take a look at the same example, but use the percentage completion method, where it gets a little bit more involved. Let's go ahead and resurrect the previous example, but let's add the information we need for the percentage completion method. So basically, to do the percentage completion method, we need to know information on the costs to date, or the cumulative costs to date, as well as the expected future costs in order to get the percentage complete. Now go ahead, if you have trouble with the entries for 2001 or 2002, you need to go back and review the text or your class notes or the previous PowerPoint presentation so you can get up to speed before going any further. In 2001, we'll recognize revenues. Again, in 2001 we're 25% complete. We've gone from being 0% complete to 25% complete. We did 25% of the work, therefore we recognize 25% of the $2 million in revenues. Likewise for expenses, the contract is profitable overall, so whatever we spent this year will be our expense for the current period. So we have costs to date for the first year of $425,000. That means we spent $425,000 this year, and so that'll be our expense on the income statement. The difference, the $75,000 profit, we debit or credit, as the case may be, to construction and process. So basically that is a plug figure. Same thing for 2002. In 2002, our percentage complete went from 25% to 60%, an increase of 35%. So we did 35% of the work, so we recognize 35% of the $2 million in revenues. For the expenses, the contract is still expected to be profitable overall, so whatever we spent this year will become this year's expense. Our costs to date rose from $425,000 last year to $1,020,000 this year, or $595,000, so apparently that's what we spent this year, and that will be our expense. The difference, we again debit to construction in process. In 2003, all of a sudden we have these cost overruns, and now we think the contract is going to be a money loser overall. We're going to continue to compute revenues in the same manner as before. So in 2003, our percentage of completion went from 60% to 80%, so we did 20% of the work this year, so we'll recognize 20% of the revenues, or $400,000. For the expenses, think of what we have to accomplish regarding income. Now, over the previous 2 years, we've recognized $180,000 in income. We showed a $75,000 profit in the first year and a $105,000 profit in the second year. It turns out that $180,000 of estimated income isn't going to materialize, and instead we're going to lose $100,000. That means that this year we need to show a loss big enough to cancel out or reverse the $180,000 of income previously recognized, plus put a $100,000 loss on the books. That means we need to show a $280,000 loss. If we've got revenues of $400,000, our expenses need to be $280,000 more than that in order to generate that loss. So our expenses, our cost of long-term contract, will be $680,000, and again the difference we're going to credit to construction in process. Finally, in the fourth and final year, we're all done. The revenues will be calculated in the usual fashion. We've gone from being 80% complete to 100% complete, so we did the last 20% of the work, so we'll recognize the last 20% of the $2 million, or $400,000 in revenues. For the expenses, again, think in terms of the cumulative income recognized. Over the previous 3 years, 2001, 2002, and 2003, we've shown a $100,000 aggregate net loss. It turns out we want to show a $50,000 aggregate or cumulative or total income. That means we need to show a $150,000 profit this year. If we've got revenues of $400,000, our expenses need to be $150,000 less than that, or $250,000. The difference, again, we credit to construction in process. Sorry, debit to construction in process.